Hey, everyone. Welcome back to Financial Mo. Today, we're diving into the world of finance, specifically mutual funds. If you've ever wondered how these investment vehicles work, their structure, and the regulations that govern them, you're in the right place. Before we jump in, don't forget to hit that subscribe button and the notification bell so you never miss out on our financial insights. Let's get started. Overview of managed products. First things first, let's understand the broader category of managed products. These are investment vehicles where a professional manager handles the portfolio, making decisions on behalf of investors. Managed products include mutual funds, exchange-traded funds, ETFs, and more. Today, our focus is on mutual funds. Overview of mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. This diversity helps spread risk and provides individual investors access to a professionally managed, diversified portfolio. Pricing mutual fund units. Now, let's talk about how mutual fund units are priced. The net asset value, or NAV, is a crucial term here. It represents the value of all the assets in the fund minus its liabilities. NAV per unit is calculated by dividing this value by the total number of outstanding units. Simply put, NAV is the price at which you buy or sell mutual fund units. Mutual fund regulation. Moving on to regulation, it's essential to ensure investor protection and market integrity. In the United States, the Securities and Exchange Commission, SEC, oversees mutual funds and the Canadian Investment Regulatory Organization, CIRO, in Canada. Regulations include disclosure requirements, restrictions on certain investments, and anti-fraud provisions. Other forms and requirements. Mutual funds have specific forms and requirements. For instance, prospectuses provide key information about the fund, such as its investment objectives, risks, fees, and past performance. Understanding these documents is crucial before investing. The Know Your Client Rule. One important rule you'll come across is the Know Your Client rule. This requires financial institutions to collect information about their clients' financial situation, investment experience, and risk tolerance. It helps ensure that the recommended investments are suitable for the investor. Requirements for opening and updating an account. If you're thinking about investing in mutual funds, you'll need to open an account. This process involves providing personal information, financial details, and agreeing to the terms and conditions. Keeping your account information up to date is equally important to receive timely communications. Examples and explanations. Let's take an example to simplify things. Imagine you're interested in a mutual fund that primarily invests in technology stocks. By pooling your money with other investors, you get exposure to a diversified portfolio of tech companies, reducing the risk compared to investing in a single stock. Now, let's say the NAV of this mutual fund is $20. If you want to invest $1,000, you would purchase 50 units. $1,000 divided by $20 equals 50. If the NAV increases to $25, your investment value would rise to $1,250. 50 units asterisk $25. As for regulation, think of the SEC and CIRO as the watchdog ensuring that the mutual fund manager follows the rules. The Know Your Client rule is like a safety net, ensuring that the investments recommended align with your financial goals and risk tolerance. And there you have it, folks, an overview of mutual funds, their structure, and the regulations in place. If you found this video helpful, give it a thumbs up, and don't forget to share it with anyone looking to dip their toes into the world of mutual funds. As always, thanks for tuning in to Financial Mo. Until next time, happy investing.